Good afternoon, everybody. We had a face-ripping rebound rally today, and I don't know if that was just pure snapback rolling off of puts, or if people incorrectly surmised, well, maybe the Fed's going to be easier on us than they've said. And I don't think that that's true. So what do we know so far? What we know is that there's been a massive drawdown in quite a few stocks. Here, Lawrence McDonald from the Bear Traps report talks about some of the S&P 500 and tech drawdowns in particular. And you see that there's a lot of companies here that are down 30, 40, 50, 60, 70, 80% as of today on a couple. And what have I told you a couple of times now? We are going to have to be very careful because a lot of stocks won't rebound. Now, weirdly, I think most of the tech drawdowns will rebound. Why? Because tech is still king. And good consumer brands are still good consumer brands. And these are still the highest margin companies out there in most cases. Companies that you want to watch out for are the types of companies that are highly in debt, aren't using technology well, and aren't really the favorites of consumers going forward. So a long time ago, I wrote an article that said, right in here, it's on Seeking Alpha. I wrote an article right in here that said, GE is going to go into the teens and stay there a long time. And it did. Now, the reality is that it had been engaged in a long-term pattern of heading down to begin with. And it finally is getting to the point now where we might actually want to invest in GE in a few years. Depends how their business turnaround continues. Remember, a lot of turnarounds fail to ever happen. But when this many companies are getting beat up, and you take a look at the S&P 500, and you rank it for 1 year return, and you start to see numbers like this, you should ask yourself, are we closer to the beginning of the correction or the end? Let's take a look at the very biggest companies in the S&P 500. And what you see is the 1 year drawdowns aren't so bad, right? A lot of them are still positive. So your mega caps, top 50 companies or so, are the ones that are carrying the market. Your Dow stocks and your giant companies. Why? Because people think that that's the market. And that's where they put their money. So what I've said to you is that when these finally come down, that's the end of the correction. And I want to make the point real strong because people are talking about selling stocks that are already down 60, 70, 80%. I don't think that makes any sense. If you really want to sell something, find something up here that you don't think is going to be quite as strong. Exxon maybe. Remember, sell the shortage is a thing. So once we get out of the mega cap space, which is right about here, about 200 billion, you start to see that the returns start to go negative, and especially the further down you go. It gets very red down here at 100 million. Even further down you go, more red spots. There's a little sweet spot there in those middle ones. It's still not a whole lot of them that are terribly down. It's really tech that's gotten the crap kicked out of it. But let's keep heading down the market cap. As you see, smaller and smaller, more and more red. There you go. Smaller and smaller. There's more red stocks. Still a good number of greens in there. So where have the losses been concentrated? The meme stocks, the tech stocks, that's where you really got beat up. So there's still some pain to come. I think if you're an S&P 500 investor, an indexer, you're in big trouble because when these big market cap stocks come down, that's going to really hammer the index. I ran this one for the SMARGE cap, I call them. It's basically your company's under 200 billion, all the way down to 2 billion. And I really could go all the way down to about 50 billion, and I'd catch everything that's not in the S&P 500. I mean, these are just, just look at this. Small and mid caps, kind of your baby large caps, just gotten destroyed. I mean, that is monumental. So I guess you should ask the question, why is that? Again, it's people don't know any better. And in a period when there's going to be less liquidity in the markets, what do you think is going to happen? The large caps will come down. The mega caps will come down. And when they do, that's it. Correction's over. But in these small and mid caps that are just beat to hell, you already have bargains. I mean, take a look at where they are on their 52-week ranges. I mean, they're way at the bottom. Look at that. So many close to 52-week lows. You do a little ranking by free cash flow, the price. You start to see, they're kind of cheap based on how much money they make. You have to pay attention to that number too and understand what industry they're in. An awful lot of small and mid caps, their fair value to cheap. And that's pretty interesting to me. I am predominantly invested in small and mid caps right now. I've been accumulating them for over a year. Then this year we're up just a shade until a couple weeks ago, back to go. We have just a ton of options expiring. So what happens when this all turns around? You're going to see spectacular gains in the small and mid caps in a more normal environment, right? When did the abnormal environment start? If you go down here to 2008 and 9, we had the financial crisis, which was a credit crisis. Then we began the age of QE. And we have had QE on and off all the way up to here, right? As soon as they turned QE off, look what happened. And now they're going to tighten like they did back here, right? This is the famous, I'm going to raise interest rates. Then 2 months later, I'm not going to raise interest rates, or I'm going to stop raising interest rates. Your taper. So do we have to come all the way back to this level? So I've told you over and over again, I thought 2016 was basically our base year in the market. We had a 2-year consolidation, which would imply a rally up into these levels. I think that's where we're going to get to, right in here. I have a hard time believing the Fed won't stop quantitative tightening when the stock market gets down here. Remember the headline I showed you last week that the Federal Reserve was expressly looking for a correction. So right around 300 on SPY, 3,000 on the S&P makes a lot of sense to me. Now, could things get worse? Could we not be able to get inflation under control? It's possible. I mean, I find it hard to believe that we can't get inflation under control when the three main things that are causing it are oil, supply chains, which have cleared up massively. That's why we got the negative number on GDP. And I'll explain that in a second. And then housing. Interest rates are up a little bit, right? Mortgages went from 3% to 5%. I watch, Realtor.com and Zillow pretty religiously, and LoopNet, because I'm looking for things. And there's price decreases all over the place. By Labor Day, you're going to have a whole bunch more housing on the market, right? We're in record building this year. It's not going to make up for years of underbuilding, but you're going to see a couple million units hit the market by the end of the year. Like I said, if they ever really wanted to lower the cost of housing, all they would have to do is put a tax on Airbnb, on short-term rentals. If they put like a 20% tax on short-term rentals, a lot of people who are trying to become Airbnb millionaires would stop, because at that point, the hotels become much more attractive to stay in. And in fact, in my trips that I have planned for the next year, unless you really want to stay in a unique house, in a unique location, you're getting a better deal at the hotels right now. The Airbnbs don't have a price advantage anymore because you have all these people trying to max out what they can squeeze out of you. And the hotels have slimmed down and rejiggered, and now they're back in business. You have cities like Las Vegas that change the rules, pass local regulations. It's going to happen in other places. Any place that has hotels that aren't full are going to pass regulations against Airbnb, and that puts houses on the market in those places. So what have I said over and over again? If something makes sense, it'll usually happen eventually. Eventually, some politician will decide to be smart, or at least get some publicity. So oil is going to come down. Why? Because we know that the United States is going to put another 1 million barrels per day on the market. We're also putting 1 million barrels per day in new production coming. So it's not just 1 million barrels a day from the Strategic Petroleum Reserve. It's 1 million barrels a day from our oil producers. And again, if the government's smart, or if this makes sense, what I'm about to say, they'll just cut a deal with Exxon and Chevron and whoever else to produce more oil on a contract to refill the Strategic Petroleum Reserve. And we'll cut a deal with Chevron and Venezuela to do the same thing, so we get the heavy sour. That's something that they recently allowed. Chevron now has the ability by law to cut a deal with Venezuela to circumvent any sanctions. 2/3 of the ships that were coming into California sitting on the sea, remember back last Christmas, they couldn't get them unloaded. 2/3 of those ships unloaded in the first quarter. And all that new inventory caused a blip in orders, which gave us the negative 1.4% GDP for the first quarter. Now, here's another reason that's not a big deal. If you go back to my several articles I've written, but in particular the Outlook, I said the first quarter is always the weakest quarter of the year. It wouldn't be unusual to see a negative first quarter here or there. Well, here it is. Did anything feel slower to you? Not really. Still can't fill all the jobs. Wages went up a tick again. And I think it's funny that people talk about how wages are causing inflation. Oh, yeah. Wages went up about 3% in the last 2 years. Woo! You should be getting your raises right now while you can. Don't wait, because we're going to get deflation again in the next few years. And you want your wages as high as possible when that happens, because then you'll get several years of differential between your higher salary based on the inflation, the deflation bringing the cost of goods and services down again. So one thing I would tell any young person or anybody is always ask for more money. Anytime you think you can get more money, ask for it, because you know why? They're going to give you a pay cut or a layoff when they need to or when they think they can. So if less liquidity causes a stock market correction into the large and mega caps, which I think it will, I don't think you're going to see them drop 80%, but I think you'll get your 20 to 30% large cap, mega cap correction. It started to a certain extent off the peak. I didn't go back, but I could. We could just go back to the 3-month returns, and now all of a sudden we can see that it's happening off the peak. So even though the 1-year returns on a lot of those stocks were all right, back to the mega caps, now it looks at the 3-month return. Still green, and now it's turning red a little quicker. So you go from the mega caps, your mega caps, Dow and whatnot. Now you're getting away from the mega caps, just your normal large caps. There you go. Now you start to see it. Looks like about 30 million. Excuse me. It looks like about 30 billion is really where it starts to happen, huh? A lot of red numbers in there. So we'll see how fast it takes to go from 30 billion to 50 billion to 100 billion to 200 billion to your monster companies. How fast does it take, or how slow does it take for these stocks to come down 30%? So Facebook was the first one. JP Morgan, Home Depot, Bank of America. Again, why would you ever own a bank when you can own Apple and Microsoft? Doesn't make any sense to me. Well, because I get a bigger dividend. So what? You lose money. Anytime there's a recession, they get destroyed. So let's take a look at this. Just going back to 2016. Here's your rally. This is normal. See how it corrects to about the same area both times? This is a financial heart attack from just something that, shouldn't happen again in your lifetime. And the Fed was able to stop it here, but it did put in place what's called a megaphone pattern. So we could get all the way back down to, 2016-ish, 17-ish level. We could. And I would call that the Armageddon zombie apocalypse scenario. I don't think it's going to happen. Jeremy Grantham sees an area in here, lower 200s on the SPY, 2000s on the SP 500. It could get there. He's a pretty smart guy. It would make sense. Usually corrections take about half as long as a bull market. A lot of times they just fall off a cliff. Like that's COVID. But from here to here, right? 3 months. This rally was about 6 months. This was a really long rally. Didn't quite get there. But if you take it from this peak, that was basically a year. And what was this? It was a 2-year rally. So again, there's no rule here. But usually a correction takes about half as long as the preceding bull market. Every now and then something falls off a cliff. The bull market from 2003 to 2007 happened in about, 5 years? From the peak of 2007 to the bottom in March of 2009, was a little under a year and a half. So that was actually a pretty fast bear market. It didn't feel that way to a lot of people, but it was fairly quick. So this rally is from 2020 to 2022, 2 years. I would expect this bear market to be done this year, probably right at the end of the year, be my guess, right in here. And doesn't it just look like from that slope, that's about what's going to happen? Could be even faster. It could fall off a cliff in the next couple of months. What if the Fed is a little bit more hawkish than we expect? And all those mega caps and large caps come down, small and mid caps come down a little bit. They probably start outperforming pretty quick before the correction is done. That's normally what happens. When everybody else is throwing in the towel, right? Your old men panic, then your indexers panic. Why? Because old men have a sense of obligation. They don't want to lose money. And indexers are dumb. Pretty much, that's the explanation. They want to talk about how smart they are. Well, I'm just in the market to be in the market. Oh, that's fine. You will never generate wealth that way unless you do it over a very long period of time. And you will never be able to tell me that you weren't smart enough to at least pick out a couple good investments along the way that beat the market. In the last, I'd say since 2017, to not understand that you should own more tech. I mean, I can't understand why people don't want to own more tech. When I tell people to be half in tech, they look at me cross-eyed. I'm like, the economy is almost half tech. How does that not make sense to you? Why would you spread your money across less important sectors that generate less revenue, that do less business? But it's the way we do things, it's the way we think. I can't have half all my money in tech. Why? Half the economy is tech. And I guess that's the one spot where the indexers have a little bit of a leg up because they're not shooting themselves in the foot by being underweighted on tech. But just with our global trends ETF, we can beat the market. Take a little bit out of 4 or 5 sectors that aren't that good, throw it into tech. That's all you have to do. That's all you have to do to beat the market. That's one of the reasons why I have half my money in ETFs. And, as I've been shifting my investment firm, it's more and more of what I'm going to do. However, this year last year and this year, I've been accumulating small caps. Why? Because I know what's coming out of this. In this scenario, the small caps always lead coming out, always, no exceptions. If there's an exception, then it would be different that time. But you should have been using your cash to buy these small caps. If you have any mega caps left, particularly Exxon, some of the others, that's where you trim. If you own the S&P 500, sell that. If you own SPY, get rid of it. That's where you raise cash, because this is the last part of the correction. You can buy it back here if you want to, if that's what you feel like. But if you have S&P 500 or mega cap funds in your 401k, get rid of them now. Don't wait. Sell them 100%. If you don't trust yourself to be a good trader, then just pick out 3 or 4 levels where you put in a third, or a quarter, and don't think about it. Down 10%, I'm putting in a quarter. Down 20%, I'm putting in a quarter. Down 30%, I'm putting in a quarter. Down 40%, I'm putting in a quarter, right? Or thirds. I'll put 10% of my money back into my fund when the market's down 10 more percent, and then 20%, then 30%. And will you have been perfect? No. But will you have taken big hunks of loss away and then gone back to compounding when it comes back up? Yeah. And always contribute to your growth funds, especially your small cap, mid cap, and emerging markets. That's where your money should be going, over half of it from your paycheck. Never change what you're contributing. Just manage the balance. And don't try to be too pretty. Just, okay, if you had sold up here, you quarter. But if you look at this, I don't know how much more perfect this could look right now, could it? Doesn't that look like it's just, here's your turnover? Does it fall off a cliff, or does it chop along and 1, 2, 3, 4, 5? Does it make the waves? I think next week's Federal Reserve meeting will be very interesting, because I don't think they're going to suddenly be a little nicer. And I think the market's going to get angry again. Now, one stock today that made a lot of news was Teladoc. Fell off the proverbial cliff here. It was pretty perfect. I flipped this box over. So that line is the same line as before. It's just, it was the bottom. Now it's the top. I didn't really know where to put this because there's not enough history to chart this properly. And as one of the things that most charting fails at is around the edges. So at the peaks, when volume slows down, that's usually a good time to know, well, okay, that means the price is going to come down. When volume dries up down here, you have to ask yourself a question, and it's a valuation question. The valuation question is this: is it so cheap right now that the technicals don't matter very much? If you're a longer term investor, that's what happens. Teladoc is trading at a PE, a forward PE of below 20, but it still has a growth rate pushing 30%. That means its PEG ratio is like 0.7. That's what Peter Lynch was always looking for. Now, does that mean this can't go down to 10? It could. Shooter's Elliott wave chart says it could go down to 10, but I find that hard to believe, because there's a group of investors out there that love this type of technology and these types of total addressable markets. Not only do you have your billionaire investor class, but you also have private equity. And the math from private equity says this is getting really interesting, because when somebody takes a company private, they're looking to roll it back out public at a much higher price. Do you think Musk doesn't look at Facebook and see how big that is compared to Twitter and think to himself, why can't I make Twitter about that big? Maybe I'll IPO it at 300 in the future, or the equivalent of 300 in the future. Private equity takes valuable assets and valuable businesses when the retail crowd doesn't understand it or punishes it, because the trading narrative is strong enough. They just pound it down and pound it down. And they make up the reasons, right? The traders make up the reasons. It went down because of this, went down because of that. They don't tell what they're talking about. They're traders. They're just going to talk their book all the way up and all the way down. Make things up. Some of them don't make it up. Some of them just lie. In Teladoc's case, they wrote down the goodwill on the acquisition they did late last year. And they had to. They didn't have a choice. They could have said, we're going to do it over a period of time. No, it's an accounting thing. There's rules. Because the price of Teladoc came down, and because the price of similar companies, what they acquired, came down, they had to write off the goodwill. It's just accounting rules. And you have a bunch of retail traders who don't know that, and it fell off a cliff. Okay. So it went from getting a slightly premium valuation, just barely. It was actually an inline valuation with their growth rate. This was obviously too high. I told you that at the time. Didn't think it would get down here. I thought it was going to get down to around 100. And it almost held right at my original box was right there. And there's old charts on the website that'll show that. And it broke through. This is so cheap that if you're an investor, all you have to do, go over to Stock Rover or whatever you're using and say, okay, let's take a look at this. You take a look at what the growth rates are. But the PEG ratio is about 0.7. 0.7, maybe 0.8. Even though their margins came down a little bit because they've been pumping money into stuff, it's still a pretty good margin, 68%, isn't it? Let me check my textbook. Yep, 68% is a pretty good gross margin. So if you go through the numbers on Teladoc, what you're going to find is that they have good growth, they have good margins, they're profitable. They just acquired a company that is going to help them a ton, and now they just wrote the whole thing off. Teladoc is a bargain right now. I am selling cash secured puts. I sold I mentioned it in the chat room. Sold the July $30 puts, got $4. So that means my net cost, if it's put to me, is 26. I'm guessing that it won't be put to me, but I'm going to keep an eye on this because I want some of these shares. Because when I do the math, right around $200 a share on this 4, 5, 6 years out makes a lot of sense. You know, if you know the growth is going to be 25-ish, 30%-ish for 3, 4, 5 years as the market penetrates, pretty easy to see around $200 a share fundamentally, which is weird because this is where it jitterbugged around for a while. Then it got to blow off top. So this is going to come back. I don't know if it gets up to here, but this area is going to come back. And my guess is it happens right around the next presidential election. That's pretty quick. It's only 3 years away, 2.5 years away. So as you know, I've been updating the very short list. I got all the growth charts done. This one is the Dow Jones Industrial plus every company over 200 billion. And some of the companies aren't quite 200 billion or in the Dow, but I included them anyway. For example, Intel. Intel's not quite technically a mega cap at the moment. It will be soon. So I included it. Once companies are comfortably above 200 billion, I'll remove them from the growth and the dividend VSL. Almost all of these have a dividend. I'm going to keep track of these for you. They're worth keeping track of. Some of these are getting interesting. Home Depot, you know, I don't love it, but it's a super low risk stock, right? Let's say Home Depot stopped being a thing. Their real estate's worth a fortune for whatever replaces it. So it's a super low risk stock. If it got down to my bottom fishing at 2.7, well, I'm going to redo the chart. But somewhere in the middle 200s, it's hard not to want Home Depot with a dividend around 3% at that point. So we'll go through these. Oh, what else? Any questions? I'll show you this chart again. This is all the choppiness from the retail crowd. Down here is where we figure out where the big money is. And really, look at all this big money in here. Never had volume that high again, even though price went up and up and up and up. Why is that? It's because these guys sucked up a bunch of the float, put it into institutional strong hands. And all these people that traded it up and then traded it back down, right? So from what I can tell, the stock's going to get to 70 or 80 pretty quick. There's big people that are going to buy this. In my career, I learned a long time ago not to try to trade unless you're really good at it, and just wait for these moments when the super rich people say they want to own it. Then copy them. If you're going to do anything, if I was to give you one piece of advice and you're going to do this by yourself, just wait until the rich people want to buy it. Profitable company, dirt cheap because retail decided to hate it because they created this momentum up and then they created the momentum down. And a lot of these people sold in here. That's why it jitterbugged. And do you think they're going to come back? Of course they're going to come back. So you should be looking to get a starter position soon. in Teladoc. It might dribble off a little bit more. That's why I sold the put first, and I'll figure out where to buy my starter position. So the problem with ETFs is they rarely work in anything but a bull market. Now, bull market is 75-80% of the time. Let's wait to buy ETFs till the bear market is over. Right now, you should be cherry picking your spots, finding the stocks that you want to own. One of the things I did on the VSL, on dividend VSL, is I expanded the REIT coverage. When I did the screening, I did the research, it was pretty easy to see. Industrial REITs, which I've talked to you about 1,000 times, that's why we own Stag Industrial, and storage REITs are the only ones that beat the stock market in the last, I think, 20 years. The housing REITs, the commercial REITs, the office REITs, the mortgage REITs, none of them beat the stock market. None, not a one. Total return or otherwise, none. I can show you some charts too. Let's pick on Simon Property. What I'd like to do is take a look at what is sexy about this chart since the financial crisis. This is really the beginning of the easy money era, about 2003. Up, crash, up, crash, up, and suddenly it's down again. I'll tell you right now, Simon Property is going to get back into this buy zone. Let's figure it out right now. So let's go back to 2000 and by 2008, beginning of the QE era. I don't think we're at the end of it by any stretch of the imagination. Let's go here, bottom to top, change it by new pretty colors. So where's the big institutional buyers coming in? Your big buyers come in here, and there was a lot of buying and selling down here during the financial crisis. There's a lot of buying and selling here. So where is this going to go based on interest rates getting higher? And think this through. Simon Property just gave the keys back to the bank on 3 malls, one right down the street from me in a great area. They don't have a fortress balance sheet, no matter what anybody tells you. They're highly leveraged. Their CapEx requirements on those malls are through the roof because they all have to be redeveloped. There's only a couple luxury ones that don't have to be. That's why they looked into buying retail, JCPenney. It's not a great business. So where can this get to? Say pretty much that spot right there starts to lose a lot of interest. Happens to be right on top of that 618 line, which is, we've noticed over time that happens over and over again. I'd say right about there. A lot of action there. Some people bought the rally. They're probably dribbling out. This support will move up right about there. Very easy to see Simon Property make a run at about $40 a share. Now, just under 100 probably makes more sense, 80-ish. But it has such a wide range because of the nature of the business. It's a highly cyclical business. The sales value of their land, because the buildings carry no value, is good, but it's not great. It doesn't justify the debt they carry. It'd be different if they bought a farm and then developed it. They don't have all those sunken costs. So they either have to redevelop those buildings or take massive losses like they did, handing the keys back on 3 malls. And to me, it says something about either their finances or their management that they couldn't figure out what to do with some really nice suburban malls. Wouldn't you think you would have just found a development partner and attached a couple of nice condo buildings or multi-use buildings so that you had built-in clients? Ever been to a bar with 4 apartments upstairs? Why do you think they do that? Because those 4 people that they're letting rent for cheap, they drink a lot. They're built-in customers. So I'm not saying every mall REIT's going to hit the bricks here again. I think Simon will. So we'll see. I said to sell it right around here. It went up. I bet it comes all the way round trip. But because it was 2 years later, I'm dumb. A lot of these people are going to hold it all the way back down. All right. Let's call it a day. I'm getting rid of my last file cabinet. For those of you who I do consulting with, I thank you, because everything is stored digitally, and I print out 1 copy of our stuff, 12 pages, whatever it is, and it's fantastic. So another question about ETFs. I just wait for them. They're not ready yet. Cherry pick stocks. They're out there. The growth VSL is ready to go. And I want to explain this to you as well. The price target, the 3 to 5 year price target, is the bottom fishing price times my multiple. So Liberty, 38 times 3 means you get it a little over 100. Warner Brothers Discovery, $20 bottom fishing price times 10. I think it's going to make a run at 200. On the dividend side, you have a lot of 3 and 4s. Why? Because a lot of these are more mature companies and they don't grow as fast. But if you can get a stock like American Tower down under 200 And I'm telling you, I think it's going to go to 600 or 700 at some point. By the way, when the price is down around here, you're going to have a dividend around 3%. And American Tower is a pretty darn safe company, right? I'm not in love with dividends the way a lot of other people are, but I understand that the perception is they're safer, and therefore people will bid them up. So when you can get them cheap, it's a great deal. American Tower is one of my favorites. If you can get in the Stag, I think that's another great one. Store Capital, they have a big patron in Berkshire Hathaway, right? So the bottom fishing price on Store is probably higher than 18. Vici, I know them inside and out. This is probably even a 5, would be my guess. I'll take a look at the numbers again. So when I did this one the other night, this took me a full day. This took about 12 hours to do. The reason being is that I didn't just draw a chart. I was going back and forth with Stock Rover to see what it looked like the growth rates would take it to over about a 5-year spread. Can't really predict 10 years, but every time you go forward a year, you can push your 5-year analysis out, right? Because now you're getting more clarity. Oh, AST Space Mobile, you see the 50 there? That means 50 times bigger than $1 billion. I think this can pretty easily be over a $50 billion company if the technology works. If the technology fails, it's going to be a $200 or $300 million company. So this is your weird speculative stock. And I got rid of one of the speculative biotech stocks. I don't have enough time to keep up with biotech anymore. It's just there is so much reading to do with biotech. I will tell you, if you want a biotech slug in your basket, buy a couple of ETFs when the prices get right. Buy one of the indexes, and then honestly, I think you buy the ARK Biotechnology Fund, whatever she calls it, genomics or whatever she calls it, because it's a good basket of stocks. I'll make one comment on ARK real quick. Even with that fund down 50, 60%, whatever it is, you know it's still a top 10 fund for the last 5 years. A lot of the narratives where they rip on her, well, she doesn't know what she's talking about with the companies, that's wrong. Their research is good. And now that a lot of these companies are cheap, they can probably double or triple that fund on accident. Where she made a mistake was in the trading. What she should have done is as money came in, she should not have invested it. She should have held cash. I'm not sure if you're allowed to do that with an ETF. I haven't even checked. But if she was allowed to, she should have done it. So she didn't hold enough cash as things started to come down. And she didn't really have much in the way of outflows. I know that she had money going in lately. She is doing the exact right thing, buying all these stocks that are down 50, 60, 70, 80%. If she thinks they're going to be in business and still growing in the next several years, they can't help but go up. All right. Have a good day.